You have to start this from understanding that you are signing a 205-page legal contract with the US government. It's not surprising that the US government wants to have some mechanism to say if you're a foreign financial institution and you're agreeing to the terms of these 205 pages, that they have some mechanism to figure out whether you're actually meeting the terms of the contract. They do that by having an obligation in contract for the responsible officer of a qualified intermediary to arrange a periodic review. Now, the periodic review itself is a highly defined mechanical test of accounts that received US-sourced FDAP income during a given year. Now, the IRS doesn't make things particularly simple here, so there are a number of different factors which determine how and when the periodic review happens. And following the periodic review, it also affects how and when a certification is made to the IRS. A periodic review itself wasn't always called a periodic review. It used to be called an agreed upon process, or AUP. But too many people thought that that sounded very like an audit. And so the change got made to a periodic review, and that's still not an audit. It's just a very, very closely defined set of tests that a reviewer has to go through on a set of accounts. The accounts that need to be reviewed are those that received US-sourced FDAP income. That's fixed, determinable, annual, or periodic. For almost all QIs, that's really going to be dividends and portfolio interest will mean that's 95% of what you're going to be looking at. Now, the periodic review itself is performed by an independent and competent person. So if you've already contracted with an expert to help you with QI status, that expert cannot do the periodic review. You can use an internal auditor to do that. They need to be able to prove that they are competent. So the issue for most QIs is, how do I find somebody that's competent and independent? Now, typically the Big Four offer these services. We offer that service, although you can't obviously have been a client of ours before, and the same applies to the Big Four. The certification period in your 6-year contract with the IRS is split into 2 3-year blocks. So during the time of your QI contract, you will have to undergo 2 periodic reviews, one with respect to each of the 2 certification periods. Now, the problem there is you've got to step back and say, well, what is my certification period? And the certification period is linked to the effective date of your QI agreement. So you need to bear with me here, because I've got to take 2 steps back in order to explain where we are in a periodic review. Your QI effective date is the date on which your QI EIN was issued to you by the IRS. That's what made you a QI. But there are 2 possible dates that can occur on. If you applied to be a QI before March the 31st and your QI EIN was issued, it will often have been backdated to January the 1st. If you applied after March the 31st to be a QI, typically your QI EIN will have an effective date of 1 month following the date that you got your QI EIN. So if your QI EIN was backdated to January the 1st, your certification period will be that year plus the next 2 years. So for example, if I applied to be a QI in February 2024, my QI EIN would be backdated to January the 1st, and my first certification period would be 2024, 2025, and 2026. My certification to the IRS would be due in 2027. If, on the other hand, I applied in July 2024, the certification period only works for whole years as a QI. And if I applied in July, clearly that year doesn't count. So if I applied and got a QI effective date of, let's say, August the 1st, then my first certification period would be 2025, 2026, and 2027. and my certification to the IRS would not be due until 2028. So when you're thinking about a periodic review, it's important to understand that your periodic review is actually connected to your certification period, and the certification period is connected to when did you become a QI? What was the date on which the IRS said you have become a QI? Now, there are circumstances in which you can ask for a waiver of a periodic review. The most common is if you're a small QI, if the amount of reportable income that you receive in each of the 3 years in your certification period is less than $5 million, you can apply to the IRS for a waiver of the periodic review. Why do I say that? Because periodic reviews are not cheap. They may not be audits, but they're almost as expensive as audits. So they can be tens of thousands of pounds to go through, and we'll find out a little bit about why that is later on. So the periodic review gets arranged, so the responsible officer has to find someone who is both competent and independent. It can be internal audit, it can be an external auditor quite often, or it can be a third-party consultant with appropriate expertise, which is why our company, T-Consult, can provide periodic review services. So the periodic review is performed on accounts in one of those 3 certification years. And if the responsible officer says, actually, I'm going to choose year 1, the effect of that is we now have to go and look at the accounts that received US sourced income in that year and check to make sure that your documentation was correct at that time, that your withholding on those accounts was correct, and that your reporting was correct. And that may seem like a fairly generic sort of approach to it. I can tell you it's anything but. It's actually very, very detailed in terms of what the reviewer has to do and how they have to do it. One of the most important factors in doing these periodic reviews is the principle is this independent reviewer has to review all of the accounts that received US sourced income in the year selected by the responsible officer for review. However, if you're a large financial institution, you might have hundreds of thousands of accounts. That's particularly applicable to retail brokers, for example. So the IRS does allow for a sampling method, but the default approach has to be all accounts have to be reviewed by this independent and competent person. If you are going to use the sampling methodology, you're either going to use the sampling method that's called a safe harbor method that's been designed by the IRS, or your reviewer is going to have their own method. Either way, the periodic reviewer is going to have to detail what that methodology was. How did they select the sample accounts? What was the size of the sample? If you use the safe harbor method from the IRS, you will never be looking at more than 321 accounts. Doesn't matter whether you've got 100,000 accounts or 1 million accounts. The maximum number you'll be analysing is 321. That's just the way the statistical formulae works. So we've got a situation in which this periodic review is required. Responsible officer goes and finds somebody who is competent and independent, engages them, and that reviewer will then say to the responsible officer, which year do you want to be reviewed? There is a connection here between the review and the certification. If I choose year 1 or year 2 for my review, then my certification to the IRS is due by July the 1st of the following year. However, if I choose year 3, then my certification to the IRS is not due until December the 31st of the next year. So by choosing the 3rd year of your certification period, you get an extra 6 months. And that can be quite valuable in terms of making sure you get things right. They're looking to make sure that you've met the terms of the QI agreement, and they're also looking for 2 other things. They're looking for material failures and events of default. Now, material failures and events of default are defined terms by the IRS. Material failures are found in Section 10, and events of default are found in Section 11. The key about material failures, apart from the obvious, which is you did something wrong and it was significant, is that there's a limitation on the definition of a material failure. A failure is only material if it was the deliberate act of an employee to get around the terms of the QI agreement. Now that's quite a high bar to try and reach in terms of proving that one of your employees deliberately set out to get round the QI agreement. What's a lower bar is whether the responsible officer should have known that that failure was taking place, because the responsible officer, as the name implies, is responsible for the implementation of that 205-page contract. And so it's much easier to get to the bar of saying the responsible officer was effectively responsible for the failure because they should have known. It's their job to know. So now we've got the periodic review, which is occurring with respect to one of the 3 years of your certification period, and which year you choose determines the date by which you have to have made your certification to the IRS. Now you're going to have someone coming into your business and they're going to be saying how many accounts in that year received US sourced income. That will usually tell them whether they're going to look at all of the accounts or whether they're just going to do sampling. Typically, if we're doing a periodic review, if the number of accounts is relatively small, in the low thousands, then we might look at all of them because we have automated tools to do that. If you're talking to a normal auditor who's doing this manually with pairs of hands, then the number might get much lower and they might automatically do the sampling methodology. The first thing they're going to do is to say, fine, we need to run the sampling algorithm. And so that just means they're going to say, give me a list of the account numbers that received US sourced income in that year. They don't want to know anything else, just the account numbers. Once you give them that list, they will run a sampling algorithm, a statistical calculation, which randomly picks out accounts in that list for review by the reviewer. Now, I say random, and the IRS understands this. It's talked about as being a random selection, but actually the IRS doesn't want it to be random, because one of the things they have to be able to do is they have to be able to recreate the sample. So they need to know from the reviewer, how did you do the sampling? What was the seed number that you used? What was the name of the calculation that you used to pick out the sample accounts? They need to know all of that, because if anything goes wrong or if they have any questions, what they want to be able to do is to come in and recreate the sample exactly as your reviewer did. Let's assume that that's not happening at the moment. We're still at the review stage. The reviewer has asked for account numbers and they're going to come back to you with a sample. So that might be 100 accounts. Your job now is to present them with all of the documentation that you used to apply withholding tax to their US sourced income. Typically that's going to be W-8s, KYC and AML information. If you allow American clients, then it would be W-9s plus the KYC and the AML information. The review of the documentation and the withholding and the reporting goes in 3 phases. The first phase is looking at the documentation. So they'll look at the W-8s, for example, and the KYC. Does the name on the W-8 match the account name on KYC and AML? Is the W-8 valid? Is it valid on the face? Does it match the KYC and the AML? And was there a treaty claim made on that W-8? So they're essentially trying to say, have you got the Chapter 3 and the Chapter 4 status of your client? Did you do the right thing in validating this W-8? Let's assume that you did. Was there a treaty claim? And if so, what was the country of the treaty claim? So what they're trying to figure out there is, how much should you have withheld on any US sourced income that that account holder received? So they're going to build up that picture. Now, in any sample, and certainly all of the sampling that we've done with our clients, nobody has a 100% success record. Everybody gets it wrong to one extent or another. The question is, are you getting it wrong systematically, Or are you getting it wrong because you've got a manual process and people just came in and they had a bad day and they didn't validate the W8 correctly? In other words, was it a one-off? And so they're looking for whether there is a systemic problem with your document validation. Now, across the total that they've sampled, if you have at least 60, you move forward into the second phase, which is how much got withheld. Now, the way in which the QI agreement is structured is basically saying, if you had failures in the documentation phase, all of those failures must be taken through to the withholding review phase. Now, if you get to the review of the withholding, you might not have 60 accounts, because that might only have occurred a failure of maybe 50 accounts. So what we have to do is take 10 accounts from the successful reviews and move them into phase 2, because each phase has to have at least 60 accounts to look at. So now we get to phase 2 of the periodic review, and they're going to look at how much did you withhold. Now, withholding is one of those things where it's very easy to get wrong depending on how you are managing the withholding of tax. If you're a non-withholding QI, someone else is doing it. And the failure may be in how you told your counterparty how and when to withhold. If you're a withholding QI, you're on the hook because you did the documentation and you withheld the tax. So some very common errors are over withholding and under withholding. So there are financial institutions out there, for example, who will say, we don't care whether you've claimed a tax treaty benefit, we're just going to tax everybody at 30%, the US statutory rate. Well, in the QI agreement, that's over withholding if that client properly claimed a treaty benefit on their W8, because the QI agreement basically requires a QI to withhold correctly, and correctly is based on what the W8 says. So there can be over withholding and there can be under withholding that takes place and is identified in the withholding phase. And the same principle applies. If there were failures in withholding, those failures, the accounts that were incorrectly withheld, must go through to the reporting phase of the review. Again, if there are less than 60 accounts moving into the reporting phase, there has to be a top-up from the accounts that passed the withholding phase. And so you end up in the reporting phase, and in this phase, the periodic reviewer is going to say, okay, now I need to see your 1042-S filing that you made to the IRS, and I need to see your 1042 tax return that you sent to the IRS. So remember, in the QI system, your job is operationally to document and withhold tax, and then each year you're reporting what you did in the previous year. Clearly, the IRS in a periodic review wants to know, did you get the documentation right? Did you get the withholding right? Because if you did, then your reporting should be fine. But if you had failures, then there is a high likelihood that your reporting was incorrect. And the reviewer's job in the reporting phase is to check how you created your 1042-S reports and how you compiled your 1042 tax return, because they should all add up. Now, if everything worked fine and your documentation was correct, then you'll get a clean periodic review. If not, then you will find that you get material failures or events of default, depending on whether those failures were deliberate acts, and in the case of events of default, whether the problem was systemic. In other words, it was happening because you were applying a rule to every account and it just happened to be the wrong rule, or it was wrongly interpreted. So you'll get through that periodic review, and typically this can take several weeks, because as you can imagine, even if you are looking at a sample of 321 accounts, that's still a very large amount of work, which explains why periodic reviews are not cheap and not quick. It's also very common that a responsible officer really doesn't understand all that they need to understand. One of the responsible officer's obligations is to have a compliance program, for example. It has to be written down. It has to have policy and procedure that say how the firm will meet its obligations. And the responsible officer's job is to get that program document trained into staff. So in principle, nothing should go wrong, but things do go wrong. Now, what's going to happen is you're going to get a periodic review report. That report might take a couple of weeks to turn up, but essentially it's going to give the responsible officer a clear picture of your compliance to the QI agreement. Now, it's important that the reviewer is not required to give a legal opinion. They're merely giving you a report that says, our job was to look at a number of accounts and say, did you get the documentation right? Yes or no? Did you get the withholding right? Yes or no? And they build up a set of information, and it's got a technical name. It's called factual information, and it's defined in one of the appendices to the QI agreement. So you can see exactly what is going to be compiled in this report. That's when the matter comes back into the framework for the responsible officer, because the reviewer's job is just to do the review. It's the responsible officer's job to actually consider the report and then do something about it, part of which is deciding what kind of certification they're going to make to the IRS. Basically, there are two types of certification. There is a certification of effective controls, otherwise known as nothing wrong here, and a qualified certification. A qualified certification means there were material failures and events of default that were identified by the periodic reviewer and not by the responsible officer. Remember, the whole point of the agreement is the responsible officer is supposed to have effective internal controls to meet the terms of the QI agreement. If the reviewer found things that you as a responsible officer had not spotted, clearly you don't have effective controls. And that means you would have to file a qualified certification. The difference between the two is if you're filing a qualified certification, you have to provide factual information that comes from the periodic review report, and you have to give an attestation personally to the IRS that you will fix any failures that were identified, and you have to present them with what's called a remediation plan. In other words, there were problems, you need to attest to us that you're going to fix the problems, and you need to tell us how you're going to fix the problems and when you're going to fix the problems. And you really don't want to get into that second scenario because it's a lot more work. We spend, or I personally spend, at least half of my life digging people out of holes that they got themselves into because they didn't plan or prepare. Most QIs, the responsible officer doesn't have enough authority to act, and they're working within a relatively small team, maybe 2 or 3 people, who are doing everything, and they have day jobs as well. And so it's very common that the QI compliance issues get left, and someone at some point says, aren't we supposed to have a periodic review? And the responsible officer might say, yeah, it's not for 3 years' time. And if you say that to someone, they're instantly just going to go, I'll worry about it next year. That's something you shouldn't do. What you should be doing is having an internal compliance review every year, because at some point you're going to have somebody external coming in and checking your working. And it could be any of those 3 years. Now, most QIs use the 3rd year for their periodic review, because the hope is that if you've been doing this for 3 years, by the time you get to the 3rd year, you should have got it figured out. And so that's a better approach. So planning for a periodic review, I would basically say, first of all, make sure you've got the resources available, because you're going to have to put resources in place so that when the reviewer says, I want the account documentation for 300 accounts, you don't spend 6 weeks trying to get it all together for them, because that sends a bad message to the reviewer. It says, maybe these people don't have the controls in place because they can't give me a simple set of account data. So make sure you have resources in place. Make sure you budget for it. These are not cheap. I have not seen a periodic review out in the marketplace costing less than $60,000. And if you're a large financial institution, you can be up at $250,000 really fast. So, this is a significant budget item, even though it only occurs every 3 years. So budgeting is one thing, planning for resources, and most importantly is make sure if you're a responsible officer that you understand how the compliance cycle works.